Real estate fans, welcome to your latest real estate market update. There's some funky things going on, new information, new statistics. Big one is that inflation has ticked up just a touch. So there's some conversation in the market in terms of the Bank of Canada's announcement come July. Are we going to hold again, or are we going to continue the trajectory with the rate cuts? Let's break it down and let's make our own assessment. Let's come up with our own idea of what's going to happen. So we know June, first rate cut we've had for some time. Okay, now obviously we know this isn't going to have an immediate impact on purchasing power, and we're not going to immediately see the price of real estate amplify, right? It doesn't happen like that. It's going to take a bit of time to see the effects of this rate cut in our market. The biggest takeaway, the most significant takeaway for me from the Bank of Canada's rate cut is that the Bank of Canada now reinforces the narrative that's been lingering that the worst is behind us. Okay? We are, I don't want to say smooth sailing. We've got a few speed bumps we've got to get over, but for the most part, predictability is back. And to make educated real estate decisions, whether it's investment or personal, we can do that with confidence, knowing that the worst is behind us and the rate cuts have begun. Now, we know we're going to have at least one more in the latter half of the year, or at least we're very confident based on today's parameters. I would anticipate probably three more. So somewhere in that range, 1 to 4 is kind of the range of rate cuts we're going to see throughout the latter half of the year. I guess based on today's inflation, the economists are predicting anywhere from another quarter point to 3/4 of a point cut in the overnight rate. This tells me 2025, 2026 are going to be awesome. And again, we're always looking at the long term, right? When in doubt, zoom out. I've talked a lot about my Brookfield lunch with the CEO, Bruce Flatt. Big takeaway, one of the big reasons they're as successful as they are in their investment world and what they do is they've got this long-term vision. They've got this long-term approach. And if you're investing in real estate for the short term, you're making a mistake, period. Your motivations are in the wrong place. So long story short, we know this is the bottom of our market for a while. And there's a lot to be excited about, really. So it might take some time to actually see the effects, but the confidence, the positivity is there. Now, wow, let's go down here. Record population growth. Okay, there's a lot of talk about this with the election looming and whatnot, but you can't stop it. And our economy, our Canadian economy, we need immigration to support our GDP growth, to support our economy, to support our outputs. Okay, so we need immigration. Maybe we can cool it a bit, but I mean, it's a drop in the bucket, right? It's a drop in the bucket. Think of the ocean. If I go with one of my Tyler McClay mugs and I scoop out some water, we can't be concerned about, water levels reducing or lowering. It's an insignificant amount. So no matter what, if we cut immigration, no matter what we cut it by, we can't reduce it by an amount significant enough to have an effect on the real estate market because our economy needs it, if that makes sense. So, I mean, you can see the trajectory here. Over the last 2 years, it's just been a steady incline. And you can see from 2010 to 2020, prior to the pandemic, that was one of the fastest paces in the developed world in terms of percentage of population increase. So, and you look at it now, it's more than doubled from that 10-year average, which is quite significant, right? Averaging just sub 400,000 a year, and for the last few months, last few quarters, we've been on pace for north of 1.2 a year. Okay, last year was a insane record. We're actually on pace to smash that record this year, but 1.27 million people. We've already brought in over 250,000 people into Canada in the first half of this year. So quite significant. Okay, this is a big one. This is a big stat. Obviously, these people need a place to live, and different than the U.S. I've touched on this before, but different than the U.S. Anyone moving in the U.S., they've got options, right? You've got 40 to 50 major cities, metro centers that you can consider. If you're in the engineering space, if you're in the banking space, finance sector, tech sector, whatever, you can look at New Jersey, you can look at Boston, you can look at Houston, you can look at Scottsdale or Phoenix, Arizona, right? You can look at Miami, you can look at Salt Lake City. Like there's metro cities all across the US. In Canada, we're limited. You've got Toronto and maybe Vancouver. Montreal's just not quite there and will probably never be there because of the language thing. Calgary's growing quite rapidly. It's not there yet, but it's growing. Another great investment pocket we can consider. But anyway, big picture, this is the immigration, and the majority of this immigration is coming to Ontario. The majority of that immigration is coming to the GTA. We are unique. Canada is unique, and the GTA is unique. Now, in terms of that population boom, as I said, a lot of it's coming to Ontario, and a lot of it's coming to the GTA. But Alberta, based on the cost of living and based on the upside potential in Calgary and Edmonton, we're seeing a lot of growth in those markets, a ton of growth in those markets. So from an investment perspective, if you can't quite get into the GTA market yet, Calgary is a phenomenal option to consider. And I much prefer it to, looking outside of Canada. We work and earn in Canadian dollars. I think you're more savvy, more wise to be investing those Canadian dollars in the Canadian economy. I think we've got a lot of room to grow, and you're going to outpace the returns in some of these markets that seem attractive, and it's fun to talk about. You're having a barbecue with your friends. I just bought a place in Miami, an Airbnb in Miami. Good luck, okay? I'm not really excited about the Miami real estate market. There's pockets in the States that I do like. Call me, we can talk about it, but Miami's not one. Some of these advertisements we see popping up for like Dubai or Aruba, Mexico, right? The fundamentals aren't there for me to be confident in those markets. I'd feel much more comfortable with you putting your money to something like Calgary. And then you go on the vacations when you want to go, right? You're not stuck to, we get to go on our vacation. We're going back to Aruba or Turks and Caicos. We're going back again. We have to go. I'd love to try Jamaica. Sorry, can't. We gotta use our condo. So, you invest in Calgary, you take those returns, you go to Greece, you go to Portugal, you go to Jamaica, you go to Turks, you go wherever you feel like you want to go at that point in time. But this just shows you a breakdown of where this population growth is moving, and you can see that Alberta and Ontario are outpacing the Canadian average. Here's some charts you might want to consider. So feel free to pause the video here, have a look at these. So basically, this is the makeup of the population growth that we're seeing in Canada, right? So non-permanent residents, these are renters. This is your tenant profile. This is your tenant mix right now. They've got money, they're studying, they're working, whatever the case may be, but they're non-permanent residents. They're not entitled to purchase property in Canada right now. We've extended the 2-year ban that we had, and it's a further 2 years from April of 2024. So renters, it means we have an immense rental pool, and you can see it on the corporate side. We are adding not a ton, but we are trying to add on the private level and the government level more purpose-built rental housing, but it's not nearly enough. So you, as the average investor, you're going to have a rental pool. This is the point of these graphs. It's showing you that we will always have a very strong and, I guess, demand that outpaces supply from a rental perspective. Okay, the non-permanent residents are a big chunk of this immigration growth. And basically, if you read my point here, I'm speaking of the fact that if the feds are serious about getting the annual population growth back to a sustainable number around 5%-ish, we're going to have to reduce the number of non-permanent residents that we're bringing into the country, which when you break it down, you see the numbers presented and the graphs presented to you in front of you. It's quite a task. It's not going to be easy. Okay, now, non-permanent residents, we need this cohort of immigration, and they contribute massively, positively to our economy. From a housing perspective, I just see tenants, like wicked tenant profiles that can't buy here. They're restrictive of buying here. So those of us that can invest in real estate and have an opportunity to own property as we embark on this London, New York, LA, Singapore trajectory that our Toronto market is on, we're going to have some pretty strong rental growth and rental figure growth. So not just the demand, but obviously when there's demand, there's an increase in rental prices. So lots of predictions in that regard. They range in and around the $8 to $9 a square foot by 2030 for rentals, which, I mean, you do the math, it's insane. Based on today's caps, that means that your average one-bedroom downtown Toronto condo should be transacting around $1 million, just over $1 million bucks. Okay, so pretty significant stuff. When we understand the makeup of the immigration, we can make educated predictions. Supply and demand. Now, this is like the simplest equation I can show you in terms of supply and demand. So the demand side, the immigration side, you can see this trajectory continuing and increasing and amplifying around 500,000 people a year. And when you look at the housing starts, we can confidently predict that the housing starts are going to be lower in 2024. We've already seen a lack of new starts in the first half of the year. And 2025, maybe we see a bit of an improvement in 2026, but we're always going to be playing catch up. It is an absolute impossibility for supply to ever catch up to demand, specifically in the Toronto core. Okay, so this stuff I'm super passionate about because it's very black and white to me, or red and green based on the graphs. But lower housing starts means lower supply, higher immigration means more demand, and the increase in that imbalance, the further away those two things get, obviously the higher the prices will be. So in its simplest form, here it is. Now, net worth. Interestingly enough, Canadian household net worth has never been higher. Canadians have never been richer. We have more money than we've ever had. Total household net worth surged by 3.3% in Q1 of 2024. That's an incredible statistic. With all the pessimism in the market, everyone freaking out about these mortgage renewals, which is really not a big deal. We have money. Canadians have money. We are secure. We are insulated, which I guess diminishes the risk that a lot of us are attributing to the real estate market. Like, again, when you break it down, the risk is dissolved. Okay, we've got the money. We've got the equity in our homes as a Canadian population. We're doing okay, despite what the media is, chirping about. Now, this may not apply to everyone. Obviously, there's like sensitivity applied. There are people struggling. There are people going through a tough time. Unemployment's up. Cost of goods and services are up. So, not to discount that. There are people going through a tough time. But from an overall market perspective, it's not a significant amount of the population, if that makes sense, to have an impact at a big level. So without trying to sound unsensitive, that's just the way it is. Now, household savings rates also increasing, okay? Throughout the pandemic, we were still making money, okay? Homeowners, the jobs that were lost were in the service sector, right? Service staff, so waiters and waitresses, airline, hospitality, that kind of effect, okay? But the bankers, the lawyers, the accountants, the HR and big companies, like, we were still working, we just didn't have anywhere to spend our money. Now, the savings rate actually rose in 2024, which is crazy because I didn't think we would outpace that savings rate, like just heading into COVID. And during COVID, there was just nowhere to spend money. So as a result of the global network, global economy, but we actually are. So household saving rates are significant. I think everyone is kind of prepping to weather a potential storm that's just not going to happen. So the savings are there. The money is there. Again, this insulates our perception of risk. It's less scary. It de-escalates that risk as far as I'm concerned. Okay, so pretty cool stats when you break them down. This is positive. And then in the news, I mean, we know what we're seeing, right? Cap, some quick points for you. We are capping the rent increase in Ontario at 2.5% in 2025. This sucks. It's below inflation, which sucks. So that's going to cause some turmoil, potentially with rent evictions and, serving N12s. I'm moving in. We have to be careful with the way that we manage our tenants, okay? But I mean, Ontario, 2.5%, like, come on, I get it. The tenants are going through a tough time. Landlords are going through a tough time. Just everyone's got to Gotta eat, right? Canada's population, I mean, holy smokes, we're talking about it. It's in the news. It's a big part of the news right now with the increase in people. We need an increase of housing, and we just can't do it. We can't do it. So again, you're going to see the emergence of cities like Calgary a little bit quicker than you otherwise would. Some other cities potentially on the rise over the next decade. I mean, I like Halifax. Saskatoon is actually quite interesting to me. Edmonton, of course. And then some of the sub-cities of the GTA. I love Hamilton. I love Barrie, Oshawa. So that's where everyone's going to live. And then, so I went out of order here. I wanted to talk about that. But based on the caps at 2.5%, there's been a motion to ban renovictions and having to apply for renoviction, having an engineer or a contractor actually sign off saying that, yes, these renovations, the tenant has to move out for these renovations, and then we have to offer it back to the tenant at the same rate once the renovations are done. So it's just getting tougher and tougher to be a landlord. I would still much rather be a landlord than a tenant. I'd rather be on that end of it, of course. So ownership is still the better option. Don't let the pessimism kind of paint a negative light in this world. But again, that's why a pre-con can be a pretty fun option, right? You park your money and chill. So I don't want to keep you. I like to ramble, especially on real estate stuff. So really quickly, I will be your crystal ball. Next rate announcement, July 24th. I'm saying rate cut. Although inflation's ticked up to 2.9 from 2.7, I'm still in the camp that is thinking we're going to see a rate cut. The effects of the first one weren't as impactful as I think the Bank of Canada was hoping or had anticipated. It just wasn't there. So I'm pretty confident we're going to see that, pending no other surprises. But that inflation rate ticking up, it's a result of services rather than goods, and you always see a lag in inflation in services versus goods. So again, it's not anything like, to me, like, whoa, inflation's up. It's growing pains. It's transitionary adjustments. It's bound to happen, but we're still sub 3, and I'm thinking rate cut July 24th. You're looking to talk about a sale, give us a call. Let's prep a plan. There are opportunities now before we get inundated with inventory to list sooner than later. Prices won't change immediately. We know this, even with rate cuts, so don't wait for that. You're going to be waiting 9 to 12 months. Your better option is to beat out the inventory. Okay? You're buying, time's ticking. When we see the next rate cut or whatever happens, I'm thinking cut, you're going to see more buyers buying, more competition in the space. And I mean, again, the supply and demand is very clear in terms of how that's going to happen. So anyway, I hope you enjoyed this 18 minutes with me. I hope you're liking these. I'd love your feedback. If there's anything you'd like me to talk about or anything you'd like me to cover specifically in the next one, reach out. I'd love to. And do me a favor, if you know anyone that might find this information relevant, share it with them. Share it with them. No obligation. Like, share my information, share my value. You have same opinions, let me know. You got different opinions, give me a call, let me know. I'd love to have a chat and hear what you got to say. So friends, relatives, network, whatever. We love working with your friends and relatives and neighbors and coworkers and whoever that might be. So thanks for your time today. Hope you learned something. But we're ready to go in the right direction. It's not going to be that. It's not going to be explosive, but it's going to be consistent over the next I think decade in terms of growth in our market. So have a great day, and thanks for your time.